Hey, good morning, everybody. Welcome to the Ankerstar Wealth a morning update. Actually, in the morning before the market opens today on a Friday, we are out in front of it. We've got a couple of cool topics for you today. The first one is something that everybody can relate to, and that's credit cards. So Mike's going to cover a couple things up front with credit cards, from talking about how much debt there is out there. It starts with T. We've been talking about trillions a lot lately, and then like different credit card companies, cards, issuers. Then we're going to segue real quick into one of our favorite banks, JP Morgan. They had earnings, so Mike will peel that back. Then I will go back to, I'll finish things off with talking about some tax reform. I don't think that stands a chance of being passed, but if it does, it's going to be kind of crazy and change a lot of the rules at the higher net wealth levels. You may be like, well, this may not affect me. Well, you don't know. Quit selling yourself short, right? You stay diligent, you may get up to some really big numbers during your lifetime. But that's what we have for you today. It's going to be really cool. Before we get going to financial education presentations, you have to do your own due diligence for acting upon anything in this presentation. More disclaimer information is available at ankerstarwealth.com. The opinions expressed are mine and Mike's alone. With that, Mike, let's talk credit card, starting with the downside, the debt.
Ooh, credit cards. I think we all have them. And before I share my screen, I'll just say that, as I've brought up some young kids able to buy their own car, they need to have established credit. And one of the ways to establish credit, probably the most common way, is through a credit card, because they certainly haven't bought any houses yet and moved out, unfortunately. So let's go to credit card debt. And what I'm showing on my screen is the total credit card debt in the United States in last quarter, or the last quarter of 2023, over 1.13 trillion, which seems like a drop in the bucket compared to the 30 plus trillion the government has. But anyways, credit card debt. But when you look at that graph, it's kind of interesting because it goes down at one point. Like, yay. Credit card debt went down during the COVID year. And if you remember, the government was mailing out checks and some people paid down their credit card debt. So that's fantastic. But I believe one of the effects is people said, wow, now my debt's paid down, I've got more to spend. And our economy, which does revolve on consumer spending, has seen the impact of this as it shot up. So with credit card debt, and let me go on, a lot of times people wonder what causes like credit card scores and how do I get a good score? And I pulled this up. It is payment history, paying your credit card debt on time, amount owed, don't have too much of a balance, history, how long you've had it, and new credit mix. And I know when people get loans for cars, for houses, all this goes into your credit score. Very, very important to have that ability to borrow money. My experience with credit cards, I used to be bored sometimes. I'd call on my cell phone. I'd call up my credit card company. I'd say, hey, my interest rate's 25%. They're like, you're not even carrying a balance. I said, it's got to be lower. Lower my interest rate. And they'll be like, sure, Mr. Yonkman, we'll take that down to 19%. And I still didn't carry a balance. And I looked this morning, I said, what are my current interest rates on credit cards? If I was to carry a balance, which I'm not, anywhere from 19% up to 29% would be my interest rate. For a friend of mine that was in debt and actually paying credit card interest, I called the credit card company for her and said, hey, you guys lowered it for me. Will you lower her interest rate? They said, absolutely not. They would not take it down since she was carrying a balance. So if you're ever going to, get into trouble with credit cards, try to get your interest rate down to start. But one thing as I've talked to different clients that have credit card debt, there is no investment that I could put you in that I would feel comfortable beating the credit card interest that you pay. So when you're paying 20%, I would never say, hey, I think I can put you in this investment and make 20% and beat your credit card interest. It's always a safe bet to pay that credit card interest down. So how big are credit cards? Let's look at market share. So Chase Bank, number one, JP Morgan Chase, and we're gonna look at their stock in just a minute. This graph's a little bit old, but the percentages: Chase, American Express, Citibank. Remember, used to hear them a lot in 2008. Capital One, Bank of America, and Discover. That's where my kids get started, is in Discover. So, and there's several more. One question that I had as I was looking at this topic this morning is, what's the difference between a credit card issuer and a credit card network? Because I hear Visa and I hear MasterCard all the time, and then I look at my Chase card and they're both there. How can they be both? So a credit card network, Visa or MasterCard, they establish the network of where you can use your credit card, and they also do the transaction. So when you do that transaction, it takes just a few seconds, but they can check to make sure you have enough money to cover that transaction. Whereas the bank, the JP Morgan, they issue the credit card. That's where you see your statement, and they're the ones that actually kind of loan you the money or hold that. And they make money on their interest, where the network makes fees off of the people using credit cards. So as far as the vendors, I thought this was interesting. So how big are these players? This is a chart of the biggest companies in the United States by market cap. You know, we know them: Microsoft, Apple, Nvidia, Google, Amazon, Meta. Wow, those are great companies, big ones that we're invested in. But keep on down the list a little bit. Number 10 is Visa. Number 11 is JP Morgan Chase, and number 16 is MasterCard. So 3 of the top 16, they're just trailing those ones a little bit, but these are $500 billion companies. These are huge companies based off our credit cards. So, you know, when we think about stocks, we are owners. We want to own things that return good money, produce products that people love, like Apple, Microsoft, Nvidia. So do people love their credit cards? I would say no. But as an owner, we essentially are the lender to the person. So when you hear people complain like, oh my gosh, I'm paying 20% on my interest, that's terrible. We don't want you to do that. But if you own a JP Morgan Chase, you're kind of the lender that's making the 20%. So think of it that way. You would rather be on that side of the equation. So let's just take a look at JP Morgan Chase and see this. I want you to check out this company, how profitable they are. And what I'm going to show, and they did not release earnings. I just was bringing up the graph of the company.
My bad. Yeah.
This is the last 5 years. This stock, which is a $500 billion company, is actually grown from like $75 a share to almost $200 a share. And if I look at the full graph, you can see this thing goes up just like an Apple or Google or Nvidia, exponentially. So these are the companies. This is what you're dealing with. You know, recommendation: try to stay out of credit card debt, teach your kids how to use credit cards responsibly, and you know, help them establish their credit line. That's all I've got.
Hey, appreciate that, Mike, and you can leave that up for just a second. Yeah, Mike said something pretty insightful there. Is, you know, we're not talking about why invest, but investing does put you on the other side of the equation on several things. You know, you are, you know, like Mike, the analogy is you're kind of on the other side of, you're the one receiving that 20% interest. Same thing with like Apple products. If you are aghast, like, oh, you are, you know, having a moment because iPhones are so expensive. Well, you know, if you own a lot of Apple stock, they're not quite as expensive because you're getting dividends. Probably doesn't cover the entire iPhone spend you have in the family, but it does take you from the working class to the investing class, if you are talking dynamics. So what's my point is, as you teach your kids about credit, the good and the bad, also teach them about investing and say, you know, hey, you can get on the other side of the equation, because largely it's when you start, you know, in investing, not exactly how you do. So, all right, you can take that down, Mike. I'm going to transition into the reason I talk about getting started young is what I'm going to talk about is some of the tax things that are coming up that really go after some folks that have done some pretty smart things. So let's read that headline first. Biden wants to tax IRAs over 10 millions and require mega RMDs. I always laugh because mega seems to be thrown around a lot. So the, excuse me. So first of all, let's just talk about sheer math. $10 million IRA. Okay, well, let's talk normal things. If somebody starts at, say, age 16, which it would be the common age for somebody to work for the first time, yes, they could have started younger, but let's use 16. Like when I was 16, my parents made me go, said, hey, get a job and we're going to start an IRA for you. And I was like, oh, free money. Okay, like I make the money, I keep it. They put the whopping $2,000 back, into the IRA for me. So they match it. So I got 100% parental match, changed my life, folks. When you look at where I'm sitting, not that you have insight into my financials, but yeah, it got me a head start that I couldn't even turn off. I mean, it was ridiculous when you start that young. But even if you max it out every year for 4 decades, which I'm sitting on, you're not really getting to 10 million. I mean, you're getting a nice fat number, I'm not gonna lie, but 10 million, you kind of have to do something unique, right? So I remember watching the election, and I think he might have run twice, but if you're a Mitt Romney, right? So I remember, okay, Mitt hits the scene, good looking guy saying some interesting stuff. And then I just remember, somebody was talking about, he's got like $100 million in his IRA. And I didn't listen to anything else, right? Because my brain got hijacked by wait, just stop. I've got an envelope right here. It's just like how much return would he have to, it's like, what's going on? So digging that a little bit, he worked for Bain Capital. He used to put options into his IRA. And I said, good to know. Think Steve will start doing that. And I have. Not as much anymore because they're time intensive. But back when I was just managing my own money, it's like, oh yeah, let's do this, right? Well, this article talks about, we'll talk Peter Thiel first, and he put, of course, I won't find it when I'm looking for it.
1,700.
So, where do you see it here?
He put 1,700 and bought.
Oh, there it is. Yeah. Thank you. Perfect. 1999, 1,700. Used the money to purchase 1.7 million shares of PayPal when it was a startup. What is that? A penny, sub penny? I don't know. I can't do math too early. But yeah, and then Palantir, and then of course Meta, Facebook, right? So yeah, he took some big swings in your IRA, in his Roth IRA. Breaking from this topic to how we invest for you. Remember, when any of our advisors sit down with you, we always talk about you take the most risk in your Roth IRA, right? Because you want to balloon that up and you've already paid taxes on it. So there is a way to get there. It's a good problem to have. But let's go back to the taxation of this. And, of all the things we do, ultimately have to pay for all of this, not the 34, evidently not the 34 trillion in debt, but at least paying for what we have right now, is where we're going to get the taxes from. I wouldn't be super against this. It isn't something that I would be, like, oh my gosh, this is terrible, but I still don't think it'll pass. Okay. So what have we got here? If it gets in excess of 10 million, you have to start taking, this is a proposal, taking a 50% withdrawal of any assets over 10 million. And then if it gets to 20 million, then you would have to withdraw everything above 20 million. Well, if you're going to do step A, you're never going to get to B, right? Because if you haircut it down to 10, you're not going to be at over 20 by the end of next year. There would be a few rare cases, and good for you if you're that rare case. But yeah, and it's not like it's stealing money from you. It's just taxing it again. So, and again, this isn't traditional. This doesn't really cover the Roth, right? So this is all traditional stuff. Most folks have gone over to Roth, so they're already like, woo, it's my Roth that would get there anyway, not the traditional. But it also slams, and you've heard me talk about this, slams the door on the backdoor Roth IRA for high earners. So right now, when you look at the earnings for a couple, I think it's up to $200 and some $1,000 is the limit. And then you have to do a backdoor Roth IRA. Well, this will stop that at 400 or 450, right, for single or married. It's like, okay, I've often said, if the government ever really wakes up to math, which they're notoriously not good at doing, obviously, minus 34T in the debt column, they would turn off the Roth IRA completely. Fantastic idea. I love it. Changes my life, probably changes Mike's life. Could change your life too. Get everything over to Roth and let it grow for decades, never pay any taxes, passes on to your heirs. they have to withdraw it in 10 years. Well, oh well, but it's not taxed, right? Unlike if you pass on a 7-figure IRA to an heir, they have to take it out over 10 years, which is probably more money than they're actually making. You never know. But if it is, I mean, they're kicking up tax brackets there. So it's kind of interesting. I do think the Roth limits, they should cut the backdoor Roth IRA, in my opinion. Plus, if you're making that kind of money, generally have enough wealth to that 7,000 that you're putting in is generally a drop in the ocean, if you will, of what you have. So why not turn it off? Okay. Other things that are coming out here, we don't know what's going to happen with the tax code. The 2017, Trump's Tax Cuts and Job Acts end at the end of 2025. So again, if Trump gets reelected, we think we're going to get extended. If Biden gets, or I should say elected again, I guess, if Biden gets reelected, then we expect that these are going to be sunset and some new rules are going to come out. Okay, last thing I want to talk to you about is there's one here at the bottom. Okay, the what it would cost. So this line right here, I'll kind of highlight it. It's saying, okay, the bill would cost 2,000 or 2 trillion, cost a minimum of 2 trillion if we pass the taxpayers earning up to 400,000. But if we extend all the tax cuts, that could cost $9 trillion to continue on the good on the taxes we have now. So why do I bring that up? Taxes are going up. That period dot, I mean, that's a guess. It's my tax crystal ball says it's got a big fat arrow going up. So I don't, you complain about it now. Oh, just wait. Kind of like complaining about your $4 Egg McMuffin when it went from 3 to 4. Now it's 11. It's going up. So things like conversions and getting things to Roth are important for you to think through right now. All right, Mike, anything to add before I let the folks go on this stuff?
No, we better get 9 of the $1 trillion coins.
Yeah, there you go. Print some $1 trillion coins. Talked about that yesterday at a conference, and we all chuckled, and then we sat back and went, oh, yeah, I don't know what we're going to do. Anyhow, don't want to end on a negative note because it's Friday. So I hope you guys have a good weekend out there, and it's Mother's Day. Don't let that slip on Sunday, and then we will see you guys back Monday. Have a good one. Bye.